Welcome back to Profiteers versus the People, everyone, the podcast where we go in and fact check the rise and influence of those who seek to impact our world with money or for it. I think this will be our last Mckinsey episode for a while. Money Mike is going to get back with us soon. We've got our next Profiteer rostered up. I've been waiting to do this one because I'm a little scared of it, but McKinsey's role is massive in the mortgage crisis of '08 and a handful of crises by which it was preceded. I'm Rad Bill. God, it's quiet in here.
This is Profiteers versus the People.
So banking and securities trading became a career path that could bring about quasi-fame in the 1920s as purchases of stocks by the public took new and obviously reckless forms. Stocks were purchased on installment plans through investment clubs and by capital rather than income, which is a bad idea. When the bubble finally burst, America did something almost unheard of today. They kinda learned a lesson, a little bit. Banks were regulated to hell and back, and the Glass-Steagall Act was put in place in 1933, which separated the commercial and investment components of banks. They now had to operate as standalone entities, which meant that runs on the bank were a thing of the past. From this point on, an implosion in our banking system has always come to pass as a result of society's willingness to forget and the earning potential of an exciting new idea. Enter McKinsey & Co. Now, starting in the Depression and carrying on for decades following, the company's involvement with banks was a means to an end. McKinsey would complete banker studies, which were required before a bank could lend money to a client. Under this arrangement, bankers saved time in the underwriting process, and McKinsey, while garnering modest fees, could get a look under the hood of organizations seeking to borrow money. Though this was vital insight for an organization seeking to back the right horses and grow, it wouldn't offset the work the company was doing for giants like GE and GM. The banks that made it through the Depression were effectively bound to single states and operated like utilities. Protocol was rigidly defined and epitomized by the somewhat sarcastically coined 363 rule. Depositors get 3% returns on what they deposit. Bankers use those funds to buy treasuries, which generate a 6% return, meaning the bank makes 3% and the depositor makes that 3% that they're promised under the first 3 rule. Then the banker is off to catch a 3 p.m. tea time. A bank run by zoo animals can carry on under this system. Home lending, too, was simple. Deposits by depositors are what banks used to lend money. When someone needed to borrow to build a home or buy a home, that's what they were borrowing, the stuff in the safe. They then paid that back with interest. Some of that interest went to the depositor, some of it went to the bank, and if the number of depositors grew, so too did the number of loans the bank was able to issue. As long as people carried on depositing money, the bank carried on lending the stuff, and Glass-Steagall meant that runs on the bank, again, were a thing of the past. So, the 3 parties, just to review, required to sustain a bank's lending practice through to the early 60s were the bank, depositors, who deposit their money with the bank with the understanding that it stands to make 3% each year. And lastly, the aspiring homeowner who borrows money deposited with the bank for, call it, 6% each year, just for the sake of easy math, half of which goes to the depositor, half of which goes to the bank. Easy enough. Both of these features of American banking, the 363 rule and this rudimentary form of mortgage lending, would change in the 60s, allowing banks to become mega clients for McKinsey. Fannie Mae was created by Congress in 1968 because they wanted more people to buy homes. But before banks lent money, again, they needed customers to deposit cash that they could offer for those loans. So they often became a bottleneck in the process. Now that Fannie Mae had entered the equation, a bank could issue the amount the borrower needed to buy the home with the understanding that the borrower would pay that amount back over time. Let's say the duration of this loan is 30 years. Obviously, this loan is paid back with interest, and just for the sake of easy math again, let's say 6%. Now, over 30 years, 6% interest paid each year means that the borrower is effectively paying $3 for every $1 borrowed, basically, to the bank. The bank can now go to Fannie Mae and say, if you give me $2 in a lump sum, I'll give you this loan that will make $3 over 30 years. Now, the bank can turn around and loan this newly double amount to other borrowers. Home run. As a heads up, this is crazy oversimplified, but the goal here is to communicate this in a digestible way. Fannie Mae was a pretty good idea. The end of the 363 system came a year earlier. The CEO of New York's first national city bank sought the advice of a friend, Peter Drucker, because although Citibank, as it was known, had enormous growth potential, the executive felt that under its current structure, none of that growth was possible. Peter Drucker, hearing his grievances, urged him to hire McKinsey, which is what he did. Part 1: Matrix Management. What McKinsey introduced was called matrix management, as the title card just said. The practice was put into action on Christmas Eve 1968. Gone were the generalists of the 363 system. In their stead were bespoke departments responsible for the needs of specific kinds of institutions. Big businesses, small businesses, retail customers all worked with separate arms of Citibank with the express goal of offering each customer the expertise of someone who exclusively dealt with their sort of business. On its face, this sounds like a pretty good idea. However, kicking it off meant dividing up existing hierarchies of generalists into segments, often promoting inexperienced or underperforming employees to positions heading new departments where they wielded considerable power and were responsible for underwriting considerable loans. Death of the generalist also meant that when a customer needed a different kind of help, they were sent to a different kind of banker, which killed the neighborhood banker dynamic once so enjoyed. It also meant that banker performance was measured by the performance of the specific kind of business they were responsible for, rather than the amount of total business happening in a specific locale, which did away with a great deal of job security for folks working at Citibank. That being said, with this newfangled focus on profits and the ability to address slumping performance on specific products, Citibank was able to become the most profitable bank in the country, and before long, other banks came rushing in to get a piece of the action. Though the top brass at Citibank would fire McKinsey for revealing the inner workings of matrix management to Citi's competitors, they would still carry on maintaining the matrix system, even as other banks hired McKinsey and adopted the exact same practice. 3 of the banks that hired McKinsey would learn a very costly and very public lesson about the one-size-fits-all solutions so core to McKinsey's modus operandi: Continental Illinois, Chase Bank, and Seattle First. Now, you're nodding because of your familiarity with Chase, but the big player among these 3 at the time was Continental Illinois. Continental was the largest bank in the Midwest, but before hiring McKinsey in 1975, it was conservative as hell. Walter Cummings, who ran the show since the bank's founding, headed FDR's bank stabilization program during the Great Depression, and it showed. The bank was heavy in treasuries, and Walter would muse that the only good loan was one that was paid off. When Walter finally stepped down, new leadership at the bank, wise to the shifting tides brought about by McKinsey, decided it was time to take on some risk. For guidance, they obviously brought on McKinsey. For a whole year, consultants surveilled and surveyed the staff at Continental to determine what changes would be needed to maximize profits. One staff member astutely observed that during interviews, the consultants were more patient than curious, almost like they knew what they were going to recommend. Sure enough, when McKinsey wrapped up their research, the answer was clear. Continental Illinois needed to reorganize in accordance with the principles of matrix management. After doing so, Continental saw a great deal of success. By focusing on profits and productivity, the bank, like all others who signed on, saw an increase in profits and productivity. After a few years, though, cracks started to emerge. Under the reorganization, John Lytle, previously responsible for $20 million in small loans, now oversaw the bank's portfolio of hyper specialized energy loans and wielded fantastic autonomy over the entire department and its $600 million portfolio. With this exciting new opportunity, John got to work. He didn't exactly understand the department he headed, but before long, he found a way around that obstacle. It's a common practice in the corporate world called docking. Now, I'm reading here that this is when one man puts the tip of his penis into the foreskin of another man's penis. Riveting stuff. I don't actually know if Lytle did this, but what he did do for sure was take part in a practice called upstreaming. You see, plenty of smaller banks did know their way around this shit, but didn't have the deposits on hand to make the loans. Remember, Fannie Mae only buys mortgages. So John, with the backing of Continental Bank, could upstream to effectively become Fannie Mae, but for energy loans. In kickstarting this practice, John Lytle was introduced to the head of energy lending at Penn Square in 1978, an innovative sounding young bank which resided in an Oklahoma City strip mall bearing the same name, Penn Square. The Oklahoma City Bank would eventually find partners at Chase Bank and Seattle First as well. After months of research and careful analysis, McKinsey had decided that matrix management was the best approach for those banks too. Now, oil prices were skyrocketing at this time, the late 70s. So, despite the fact that Penn Square was underwriting terrible loans at incredible speed, the three larger banks were none the wiser and went right along buying the loans and cashing the monthly principal and interest. Lytle didn't know what he was doing, so he just carried on and climbed the ranks at Continental, while executives at the bank carried on cashing the checks. By 1982, Lytle had climbed the ranks at Continental Illinois, thanks in large part to his energy loan portfolio, which had grown to $1.2 billion. Despite the fact that most of this growth was the result of Penn Square generated trash, Continental Bank was now the largest commercial and industrial lender in the country. Its head executive was the highest paid banking executive in the country, making $710,000, or just shy of $3 million today. And Dunn's Review had declared that Continental Illinois was one of the most successful companies in the country. And then the economy took a dive, and oil prices tanked right along with it, and suddenly all that trash began to stink. Regulators caught wind of Penn Square's bullshit and shut the bank down in July of that year, forcing Continental to post its first loss since the Depression. Chase Bank was also hit hard, as was Seattle First, which shut its doors the next year and was acquired by Bank of America. In the spring of 1984, Reuters published a rumor that Continental faced bankruptcy, which, in time, caused many of Continental's big corporate clients to pull their deposits and forced Continental into bankruptcy. In July, the government took a majority stake in Continental, effectively doing what we now fondly refer to as a bailout. Until 2008, it was America's biggest bank failure, and it birthed the notion of a bank or business being too big to fail, which would become relevant once again in about 23 years. McKinsey consultants uninvolved in the banking practice took note that the strongest banks of the time were the ones that ultimately abandoned the matrix management system. Some refer to the program as the very snake oil that well-run banks tried to steer clear of. Paul Volcker, who headed the Federal Reserve, was quoted as saying that he knew a bank was headed for trouble when it grew too fast, moved into a fancy new building, made the chairman of the board head of the art committee, and hired McKinsey & Co. to do an incentive compensation study for senior officers. So it was. Part 2. McKinsey bounces back. As the American economy financialized, it sort of started kicking McKinsey's ass. Though matrix management was a disaster, for the fallout, they had built a base of banking clients to which they could redeem themselves, and they theoretically had the manpower to come up with something big, although ironically, the very same banks they were trying to court were courting all of their young talent. Worse still was the impact that Boston Consulting Group and Bain, each a younger competitor to McKinsey, were having on McKinsey's pool of financial clientele. They were invading the market and poaching clients with the absurd approach of coming up with individualized strategies. So, McKinsey needed to do something and quick. Thankfully, Lowell Bryan, who was hired by the firm in 1975, had just the solution. He'd watched from afar, expressing deep distaste for matrix management, noting that it was amateurish and had been created by marketing and organizational consultants rather than financial consultants like Bryan. His $1 million idea was one he saw through the window, so to speak. Financial innovators at Salomon Brothers and First Boston had sauntered into the very same business as Fannie Mae and Freddie Mac, but to a broader degree: securitization of credit. Where Fannie Mae and Freddie Mac covered most mortgages, Salomon Brothers and First Boston were covering the others, as well as auto loan debt and credit card debt. We all have PTSD, but this idea was huge. What stunned Bryan, and where he saw opportunity, was that the practice didn't seem to be catching on. So the solution came into focus. Take the idea that First Boston and Salomon Brothers had already begun implementing and publicize the living shit out of it. Then generate fees by giving it to every securities firm and commercial bank that asked. In 1986, Bryan inaugurated the Securities Project with the aim of selling it to everybody, starting, of course, with McKinsey's enormous existing roster of money center banks, securities firms, and insurance firms, which is exactly what they did. Against a current of failures by savings and loan companies and that of continental Illinois, they pulled it off. According to Bryan, securitization could free more than just banks. It represented freedom for any company from the straitjacket of their balance sheet. As mentioned with the ditty before about Fannie Mae, any opportunity a bank has to get loans off its balance sheet is pretty alluring stuff. A loan on the books has to be backed up by cash reserves. Getting that loan off the books means that the bank can use those cash reserves to write more loans, which it can sell again. Write a loan, sell the risk, use the cash accrued to write another loan. As Bryan put it, securitization is a great measure because it removes capital and balance sheets as constraints for growth. Not only is the practice effective writ large, it's pretty simple. Set up a special purpose vehicle, inject the assets, which would be loans that borrowers were going to repay, like mortgages or auto loans, and then sell this newfangled bundle to investors. In Bryan's mind, this arrangement was good for investors as well. A system where the originator, the one writing loans and assembling the security, the credit enhancer, which is the bank or insurance agency, providing a guarantee on the product, allowing it to then receive an investment grade rating, and the rating agency all scrutinizing these loans as an alternative to the old system where individuals, pension funds, and the rest had to comb through and make the determination as to whether or not an investment vehicle was safe, represented a pretty compelling win-win. Michael Lewis's The Big Short leans heavily on this notion that the problem was Wall Street's being completely unwilling to crack open an investment prospectus, but that was like half the value proposition here. Save the money on review. The program self-governs. Banks that wrote bad loans would be pushed out of the system naturally and forced to improve their practice. In theory, this would lead to a culture that naturally enforced sound decision-making at the origination level. To kick off their campaign, Brian's team released a barrage of books and articles on the practice, becoming one of its loudest proponents. In 1988, Breaking Up the Banks, authored by Brian, turned up everywhere and put securitization at the center of a theoretical overhauled banking system. Securitization of Credit, which was authored by a few of his underlings, James Rosenthal and Juan Ocampo, that same year was also extremely popular and provided a how to for implementing the practice. The Journal of Applied Corporate Finance dedicated its fall 1988 issue to the practice. Of the 9 articles featured in that journal, 3 of them were authored by McKinsey. Next, McKinsey deployed partners across the globe to spread the gospel about credit enhancements, special purpose vehicles, and asset tranches to the uninitiated. Among the hardest to persuade were issuers of auto loans like GM or of credit card debt like Bank One. Commercial banks, on the other hand, were an easy sell. Once word got out about McKinsey's work in the arena, the largest banks in the world came to them, asking what they could do and how to use specific assets in their transition. In no time, McKinsey was on board helping banks set up trade finance divisions, pushing for internationalization or a specialty in asset securitization, but also coaching commercial banks on how to change so that they could accommodate more risk and get higher returns. Setting up a securities department wasn't just about poaching talent from rivals. In many cases, investment bankers at the more buttoned down banks, who would typically specialize in these sort of loans, kind of had to be coached to take more risks. The culture of their departments had to be fundamentally altered. In 1990, the Federal Reserve analyzed the core tenets of the practice and issued a report which ultimately supported securitization. The report's bibliography was filled to the brim with McKinsey literature. Proselytizing the concept to Congress, Brian guessed that securitization would replace the current banking system in under 2 decades and compared its introduction to the transition from vacuum tubes to transistors to integrated circuits. In 1996, he partnered with Diane Farrow to author the book Market Unbound: Unleashing Global Capitalism, which noted the increase in securitized loans from $100 million in 1980 to $1 trillion just 12 years later. The two predicted sustained growth of the practice, particularly overseas. To be sure, there were warnings of the potential dangers of blitzscaling this practice. In McKinsey's literature, there were warnings of how any corruption by the 3 governing bodies, the originators, the credit enhancers, and the rating agencies could hasten a credit collapse. Also, in 2002, Enron, which was run by a McKinsey alum, Jeff Skilling, painted a dire warning against abuse of the practice when it crashed and burned by abusing securitization. But that too went completely unheeded. Though most ordinary Americans wouldn't be affected by Enron's collapse, the entire world would be badly impacted by the freakish derivative investment vehicles responsible for Enron's demise. When interest rates plummeted after 9/11, the self-governing system so heavily praised by Brian began to self-destruct. Home buying looked to be slowing in pace, so to keep demand up for those mortgages, banks began targeting higher risk home buyers, coaxing them through the door with interest-only mortgages, adjustable rate mortgages, mortgages with balloon payments, and mortgages with extremely gracious teaser rates. Wall Street investors, hungry for higher yields, began partnering with companies like Ameriquest and Countrywide to start buying and securitizing these riskier subprime mortgages. The ridiculous derivatives they were peddling depended on the continued flow of mortgage-backed securities, and the credit agencies, completely dependent on fees from these Wall Street firms, either missed or chose to ignore the fact that these high-risk borrowers were defaulting in droves. So they carried on giving these subprime mortgage-backed securities the investment-grade rating they needed to continue poisoning the economy. On January 2nd, 2007, Mayor Michael Bloomberg and Senator Chuck Schumer made an appearance in the Blue Room in New York City Hall to warned of the threats that regulation posed to the U.S. economy and the rising odds that Europe would overtake the U.S. as the leader in securitizing credit. This was despite the fact that regulations of Wall Street were getting repealed pretty aggressively for years. In fact, in 1997, a law keeping risky investments separate from retail deposits was repealed, and in 1999, the Glass-Steagall Act was repealed, which we mentioned earlier in the episode. Now, speculation about conflicts of interest are pretty reasonable here. Michael Bloomberg was a billionaire many times over thanks to the platform he created to sell information to Wall Street. Chuck Schumer had up to this point tapped Wall Street for $250 million in funding for Democratic hopefuls and incumbents across the country. Anyways, the two presented a study authored by McKinsey, which warned of this imminent threat and claimed that Europe was leading the U.S. in derivatives already. According to McKinsey, what the U.S. needed to do to avoid continued marginalization on this front was weaken parts of the 2002 Sarbanes-Oxley Act, which was enabled to prevent the kind of corporate fraud deployed to allow the pilots to escape as the Enron rocket came crashing back down to the Earth's surface. Mere weeks after this presentation was made, the economic crisis found its way into the spotlight as Century Financial, an enormous subprime lender, collapsed. Suddenly, that McKinsey study touted by Schumer and Bloomberg vanished into thin air. In July of that same year, Bear Stearns began its 9-month voyage to the bottom of the ocean as two of its hedge funds went up in smoke. In March, the firm's skeletal remains were purchased by Morgan Stanley, which itself would require a $107 billion bailout to stay above water just 6 months later. That same month, September, Lehman Brothers and Washington Mutual sent their employees home for the last time, and a 6-month-long bailout process began for AIG, which was unable to pay $182 billion of credit enhancements. In similar fashion to Bear Stearns, Wachovia and Merrill Lynch, both McKinsey clients, were sold off to stronger competitors. Between 2001 and 2008, $27 trillion had been securitized. When the depths of the crisis were reached, a vast majority of this capital was gone. Mark Pittman, a journalist for Bloomberg, was one of the few who predicted the crisis. Researching and writing about the origins of the Great Recession led him back to Rosenthal and Ocampo's book, Securitization of Credit, and the investment vehicles set up by Skilling, the McKinsey alum at the helm of Enron, during its demise. Thank you all so much for listening. Hope it was informative and at least a little entertaining. Be sure to like, comment, and subscribe. Money Mike's going to be back for the next one. Also, please don't hesitate to leave a review. In fact, it would be pretty cool if you could. I love you. Money Mike also loves you. He would say it himself if he were here. Again, like, comment, subscribe, the rest of it. And goodbye.